Hello, everyone. This is Software Journey with Learn to Code with me. And today we're going to talk about what happened if you purchased call options or if you sold perhaps called options or covered calls on Hive after the reverse stock split. So I know this may seem confusing. Some of you may be wondering, am I losing my money? And, do I get to keep my money? Whether you're on both sides of it, whether you sold the call options or whether you purchased call options. The same applies to puts. Just go ahead and reverse that logic a little bit, but let's go ahead and take a look at an example. So first off, let's just make sure we understand what the reverse stock split is. If you don't feel comfortable with that, just please refer to my previous video. But essentially what happens is there was a 5-to-1 reverse split, which means that for every 5 shares that you previously owned before the split, then it would be converted to a single share. So let's take a look at an example. Say, for example, you owned 1,000 shares of Hive, right? And you purchased each of them. Let's say your average cost for each of them was $2. So that ends up being about $2,000 of equity or $2,000 cost that you put down to be able to own those shares. Makes sense. Now, after the reverse stock split, so this is going to be the 5-to-1 specifically, then we essentially just have to divide this total number of shares by 5, and you can see that you only have 200 shares of Hive. So that might be a little bit concerning to some people, but once again, this is just manipulating the numbers. This doesn't actually manipulate the values. So you'll see that the actual price increased by 5-fold. So then you would actually have 200 shares of Hive at $10, right? So that would still have that same amount of equity. You're not really losing any money out there. It's no different than saying, for example, I could have one whole pizza, or I can have 2 halves of a pizza, right? That's all it is. Actually, in this case, since it's a reverse stock split, I can have 2 halves of a pizza, start with 2 smaller pieces, merge them together to make the whole piece, right? Let's say, I don't know, glue the pizza together, I guess. And now I have that whole pizza. It's still the same value. It's still the same item as the 2 halves. It's just a different representation of it, right? So now let's consider calls, because I think that's where perhaps many of you may be concerned. Let's say you, and in this case, I rented out calls. I sold covered calls and ended up making, I'm on track to make about 30,000 this year just from selling covered calls. So that's definitely something I'll make a video about if you're interested in learning about. But once again, this is not financial advice. This is just for entertainment purposes only. So if you had 50 calls, and let's say that you had a strike price of $2, meaning that you were essentially you're able to buy them at $2, and at $2 no matter what the price is, right? So let's say it goes up to $10, so that would be excellent for you if you had those calls of Hive for the expiration date of December 2022. And let's say you paid a premium of about 0.8. Or in other words, saying it 80 cents. But since each of these calls typically represent 100 shares, then you have to multiply that by 100, and that's about $80 of rent. So if you're selling the covered calls like I did, so then you would receive about $80 of rent. So since you have, for each of those calls, since you have 50 of them, that's about, you have to just do 50 times 80. So that multiplication between those two shows you that it's about $4,000 of rent if you were selling them out, right? And if you were purchasing them, then it would be $4,000 of cost, essentially, to have 50 calls. And once again, each call in this instance represents 100 shares, or represents 100 shares. So 50 times 100, that ends up being about what, 5,000? Yeah, so 5,000 shares. Now, once again, I just want to stress this represents 100 shares. The reason why I say this is because it's going to change after the reverse stock split. So one call means you may buy 100 shares at the strike price of $2, which is essentially meaning $200. So if you do $200, divide that by your 100 shares, you see that it's really $2 per share you would be able to purchase it at. Okay, so far all of this straightforward, I hope. Now let's look at the reverse stock split. Now, for this, and actually let me go ahead and just notate that it's 5-to-1. I just want to note that when this happens, the strike price remains the same. Okay, just kind of keep that in mind. The strike price remains the same. What gets altered, actually, let me write this down. What gets altered is the number of underlying shares. So this whole time I've been mentioning to you that a call or a put in always represents 100 shares. Now that's not the case in this instance. When there is a reverse stock split, they don't change the stock, the strike price. They don't, for example, in this instance, they change the stock price, right? So you can see that they manipulated the price. Here, they don't change that strike price. Here, what they do is they alter the number of shares that the contract will represent. So you still have your 50 calls after the reverse stock split, and the strike price is still $2. Still going to expire on the same date, still going to have that same amount of premium. Actually, the premium, so if you were renting it out, it would still be the same amount of premium, actually. That doesn't get affected whatsoever. Now, the only thing that changes is that each call now represents less, right? So it represents less. You go ahead and just divide it by the conversion amount, which is, you know, divided by 5 times. And so you see that each call represents only 20 shares, but the strike price remained the same. So what happens to each of these calls? That means that one call means, so if you want to go ahead and exercise that option, you would only be getting 20 shares. You wouldn't be getting the 100 shares. So you might say, oh, this is excellent. You know, I only have to pay $200 for that one call. Yeah, because the strike price remained the same. However, you're only getting 20 shares. So if we do that division, $200 divided by 20, you'd see that really you're still purchasing it at $10 per share. And this translates roughly to what was happening before. So you see that you would still be exercising at $200. You would still be exercising at $200. We just manipulated the number of shares that you would be able to purchase. And what that's saying is that essentially, if your position was to buy at $2 before, now it's at $10, essentially, right? So that's just kind of how they change up the math a little bit to make it all equal. So say, for example, if you did have those $2 calls and you wanted to get, you were thinking HIVE would get past $2 in December, then now you're thinking that it's going to get past $10 in December. Really, that's just the simple math of it. I still think, you know, HIVE is extremely undervalued. I am confident, but I also would like to say that I think hedging bets is always a smart idea. That's why I actually have a number of these calls available. Actually, I'll make a different video just kind of explaining my position and the kind of covered calls that I sold. But just know that if you were purchasing calls, which, you know, I just don't myself do, just because I think it's a bit riskier, because you have to have an established time frame. But anyways, if you purchased some calls for, let's say, like $2, just go ahead, or whatever strike price, just go ahead and multiply that by 5, and that's what you need it to be by that time frame to be profitable. Now, I will say, with the reverse stock split happening, generally speaking, there's negative sentiments towards it. If you haven't seen my previous video, that, you know, I think HIVE is built differently than other companies that have gone through reverse splits because it's profitable. It's, you know, it's making money, large amounts of money relative to its market cap, in contrast to other companies. You know, I kind of like to point out to, like, GameStop, which is losing. It's lost about like 9% of its assets within the past 3 months, or within the past quarter. So just know that, you know, I see HIVE a little bit different. It's just more out of necessity due to how the market's behaving. But I think personally it's it's in a strong position. Now, would I purchase calls? I just wouldn't purchase calls in general. But would I purchase more shares and load the boat? Absolutely. That's what I've been doing. So I hope this makes sense. I hope that this provides clarity on, you know, what your position kind of looks like now. But the bad news is, generally speaking, after the stock splits happen, people are going to be less incentivized to purchase those same calls. So you might have lost money on the reverse stock split, just as it stands at the moment. Even though all the value has stayed the same, it's still about 80 cents, because it's $4 divided that by 5. It's still about 80 cents per share. However, you know, you might have seen the value go down just because the volatility has changed as well. So just some things to consider. Thank you so much for watching. If you enjoyed the video, always feel free to like and subscribe. You know, I'm going to keep pushing out content here. I'll talk a little bit about my position and some other perhaps entertaining facts along the way. And I hope you have a wonderful day.